Okay, the queries have started coming in. So Vishnu wants me to explain about the Dow theory. Rupashri wants to explain about the Bollinger Band. Okay, there is one more thing I would like to clarify here is that it will be better if you do not put such open-ended questions, because then what will happen is this will become a full-fledged technical analysis session. Okay, so if there is anything specific in the Bollinger Band that you did not understand, you want me to clarify, please ask it like that. Be specific in your question. Like what is Dow theory? It's a big this thing. So like that, if you start covering every topic, then it will become a full-fledged technical analysis session. We don't want to do that. Okay, so Rupashri, to answer your question, what is it that you want me to clarify in the Bollinger Band? Bollinger Band gives us a range. Basically, it is a combination of the range as well as a volatility of the market. So it works as a standard deviation. Let me see if the chart works. So I will show you the current chart. If you can see my screen. Just give me a minute. I'm trying the charts. Okay, so the real-time chart is not working. So what I'll do is I'll just explain in brief what Bollinger Band is, and then you can probably ask me specifically what is it that you would like to know more about it. Okay, so I've opened a paint window. If you can see my screen. So let us assume that the market is moving up and the 20-day moving average is somewhere like this. Okay, you understand what moving average is? 20-day moving average is the average of the previous 20 days. Okay, so let us assume that this is the 20-day moving average. So what the Bollinger Band will do is it will give you a standard deviation, two standard deviation on the upside and two standard deviation on the downside, to give you a range that if this is the momentum of the market, then what is the maximum or the minimum between which the market will is likely to stay. Okay, so with a 98% chance that the market will stay within that range. Okay, so let's say in that case the Bollinger Band would be something like this. So if you can see my screen, the orange range is the Bollinger Band range, and the black one is the 20-day moving average. So what will happen is the market will remain within this range. So if it is a line graph, let's assume for Nifty, then you will find that the Nifty is within that range. So you can see that the blue line, which is the assumed Nifty line, it sometimes is above the black line or sometimes is below the black line, because it's the black line is the moving average line, but it never goes beyond the orange line, because that is the Bollinger Band. So that way the Bollinger Bands kind of helps us in understanding the range of the market. There are other trade signals also. Okay, for example, I'll give you just one example. For example, let's see in this particular case here, hold on. If you look at this, the circle that I've made here. Okay, so what we are seeing is that the Nifty has touched the higher end of the Bollinger Band and then it is retraced. Now what will happen is once it starts retrace, it will either retrace and then again go back, or it will retrace a little bit more. So how do we know which way the market will move? So what happens is once it touches one end of the Bollinger Band, it might be the upper end or the lower end, and then it starts retracing. Then once it crosses the black line, which is the 20-day moving average, then we can safely assume that the trend is now going to take it to the other side of the Bollinger Band. Now in this particular case, it's a hypothetical line that I have made, so it is not very clear here, but in a real life scenario, you'll find that in this case, once this line is crossed, then the chances becomes very high that now the market will go further down, and then it will touch the other side of the Bollinger Band. So here is where the trade is initiated. Okay, similarly, the same example, if we look at from the other side, that if the market has touched the lower end of the Bollinger Band here, and then it starts moving up, and then as soon as it crosses the black line here, okay, so that is where a buy call will then be initiated. So that is how the Bollinger Band is used for initiating trades. So Rupashri, if there is anything specific you want to know about Bollinger Band other than what I just said. Vishnu, I'm actually not understanding your query. You are asking about the Dow theory. See, the Dow theory is nothing but a kind of a guideline based on which the entire technical analysis parameters are based. The Dow theory in itself is not a let's say a pattern or a any indicator based on which you can go for a buy or sell. Okay, so there is nothing as such that how do you apply a Dow theory in a stock price movement. It's not like that. Okay, it's the basic assumptions that the a technical analyst make is what is Dow theory. Okay, Rupashri, to answer your question, are you asking about the formula of the Bollinger Band, how the upper end and the lower end this thing is derived? In that case, I'll suggest that you simply understand just one thing. That is the base of the Bollinger Band is derived from the 20-day moving average. Okay, so first you have to calculate the 20-day moving average, which is the exponential moving average EMA, and based on once you get that number, then you just simply do a standard deviation, two standard deviations actually, on the upside and on the downside, and that will give you the band. In fact, in most charts, the band is ready-made. Right now, I'm not able to get the live charts. I'm not able to show you. So there is no need for calculation actually. All you have to know is how to apply it. So if you can see the picture that I've made here, then you'll get a fair idea of how to apply the Bollinger Band. Yes, we'll wait for one more minute for more questions to come in. Okay, so this is a link that has been shared by Anand. This is the Economic Times charts. Let me see if we can see the Bollinger Band here. If there is any facility to see it, then we can see a live example. Okay, so one Bollinger Band is created in this chart. If you can see this. Okay, so based on the theory that I just explained, if you look at, I mean, just follow my cursor for once. If you look at this area here, if you're able to follow my cursor, this is where the market touched the lower band of the Bollinger Band. Okay, and then it started moving up. Now once it started moving up, that is not where you have to go long, because many times it happens that the market will remain within the middle line and the lower band. What you have to wait and see is whether the market is convincingly clearing that 20-day moving average. So right now the cursor that you can see is where the market has cleared the 20-day moving average, and then it continues the journey, and just look till where it goes. It goes to the upper end of the Bollinger Band, and then from there it reverses. So once it is coming down, you have to wait till it crosses the 20-day moving average. Now here, if you follow my cursor, this is where it is the 20-day moving average is being crossed, and then see it just goes further down and then touches the lower end of the Bollinger Band. Similarly, that is how it keeps on happening. One or two examples you'll also find that where the moving average has been crossed but the upper end was not reached. So those are one or two exceptions, but by and large this is how the Bollinger Band movements are being used for practical trading purpose. Okay, so for example, once again, if you follow my cursor here, this was the day, the budget day, the Nifty touched its low. So the low was I mean the low point of the day was where the Bollinger Band lower band was, and then it started moving up, and as soon as it crossed the 20-day moving average, that was the time when there was a buy signal technically. So if you had gone long at that time, then you can see the kind of returns that you could have made. So coming back to the current scenario, if you look at how the market is behaving right now, if you have followed the market for the last couple of weeks, you would have seen that the volatility has gone down significantly, and the range of the market has become very, very narrow. Okay, as it is clear from this chart. So what you are able to see is the trading band that was there, the Bollinger Band, has shrunken. Okay, so this thing has become very, very narrow. The range between which the market will trade. So right now, once again, by and large, it is staying above the 20-day moving average. So if maybe tomorrow or within a couple of days, if we see that the market is breaching the 20-day moving average, then technically for a short term, that will be a sell signal till the lower band of the Bollinger Band. Okay, so if you have to apply this theory in the current market scenario, that is how you have to wait. That is how you have to apply it. So you have to currently wait till the market crosses the 20-day moving average on the downside, and once it crosses it, then you have to you can technically initiate a short position when the target in that case will be the lower end of the Bollinger Band. Okay, there is a good question asked by Rupak here, which says that how do we correlate Bollinger Band, RSI, and MACD in trading in Nifty or in a particular stock? The reason I'm saying this is a good question is because you get an overall sense of the market from all these indicators. First of all, these are all indicators that we're talking about. What are indicators? Indicators are tools that gives us an indication of which direction the market is going to move. Now there can be three directions in the market. One is if either the market is going up or down, or the market is going sideways. Okay, so the indicators should give us a direction. Now the three things that has been mentioned by Rupak here, Bollinger Band, RSI, and MACD, are quite different in their the way they give us an indication of the market. For example, RSI, if I take that as an example, RSI is a oscillator indicator which gives us a sense of the momentum of the market. Okay, which direction the momentum is. Now RSI is known as a leading indicator, which means that if you look at the RSI, let me see if in the live chart if I can see the RSI here. Give me a minute. Okay, look at this here. Just follow my cursor here. So what you can see is the RSI is an oscillating kind of an indicator which keeps on oscillating between the numbers 70 and 30 normally. And what basically it says is whether the market is in an overbought or oversold zone. The theory or the assumption behind that is if we see that the market is in an overbought zone, then the likelihood of a correction increases. So which means that first the indicator will show that it is a on the bought or oversold zone, and then the market will change its direction. So in that sense RSI becomes a leading indicator. So the indicator comes first and then the price movement comes. MACD is exactly opposite. In MACD the price movement first happens, and then the indicator kind of confirms the price movement and says that yes, the market is either going up or down. So it is called a lagging indicator. So if you are looking to initiate a trade, then MACD is not something that you should follow. MACD is something you should follow if you are already in a trade and you want a confirmation of the trend. That, let's say for example, if you have gone long in the market and you want to know for sure if the trend or the direction of the market is really up or not, then that is where MACD will come into the picture. Okay, so RSI, MACD, Bollinger Bands, all these things serves different purposes. So when you are using all of them practically, what happens is you should keep like 4 or 5 indicators handy. You do not have to go through all the indicators that you have learned. Okay, because sometimes it will happen that one indicator is not giving you a clear signal. At that time you can refer to some other indicators and find out if that is giving you some signal. The thumb rule that is normally followed by practical traders is, if you are tracking at least 5 indicators simultaneously, then at least 3 or 4 of them should give you a consistent let's say indication, either of going up or going down, or or going sideways or whatever. Because if there is a mix, let's say for example 2 are saying up, or 2 are saying that the direction is not so clear, another one is saying it's down, another 2 is saying it's up, then it's a confusion in the market. And that is a time when trades are normally avoided, or fresh positions are normally avoided, and people put in a stop loss for their existing positions, and they just simply wait to see if the stop loss is getting hit or not. Okay, so there is no, I mean, if you just follow one indicator or 2 indicators, that is not something, that is not a good practice. So if I have to just to give you an example here, like I said here, there was a situation where the Bollinger Band had crossed the 20-day moving average from the downside, but it did not go up. So if you had to take a trade signal simply from here, then you would have gone long, and then target would not have come. Instead, if you just follow the cursor down to the RSI zone here, you'll find that the RSI, even though it was going up while the market was going up, then from here it suddenly started going down. So the RSI at that time, when this 20-day moving average was being crossed, was not showing a very positive signal. In fact, on the contrary, it was showing that the momentum of the market is likely to go down from here. So that way, if you had followed both the signals simultaneously, you would have seen that the Bollinger Band is saying that you should go long, but the RSI is not giving you a long signal. So probably you should wait. So that way, it could have saved you stop loss or something. So that is how, practically speaking, these technical tools are used. So 3-4 technical tools are seen simultaneously. Now, which are the technical tools that you should see? There are a few which are very common, like RSI, moving averages, this Bollinger Band, even stochastics is followed very popularly. Then there is MACD. So these are the 4 or 5 indicators which are normally practically used. Other than that, also you can use any other indicators. Also depends on how comfortable you are or how well you understand that indicator. Many a times it happens that the market participants, they simply follow 1 or 2 indicators, and then they kind of see how much the market is respecting those indicators. If they see that the market is really respecting the indicators, for example, if I take the case of Bollinger Bands here, you are seeing that the market maybe sometimes it is respecting, sometimes it is not. So Bollinger Band probably will in this current market will not give you a very clear indicator, but maybe RSI may. So at that time, that is how you kind of select the indicators. Anand, to answer your question, Anand's question is, should we go with the trend or should we just simply follow the Bollinger? Again, to repeat my answer, number one is you cannot follow the Bollinger Band only. You have to simultaneously look at other indicators also. Bollinger Band, if you are someone who follows Bollinger Bands very regularly, you'll be very comfortable with it. So the Bollinger Band might give you the first indication of the trade, For example, you might from the Bollinger Band, you might get a sense that you should go short or long in the market from the short-term point of view, but you should always reconfirm it with the other indicators. That if the other indicators are also giving you similar signals, because if it is giving you the same signals, then your call become that much more surety of the call increases basically. Okay, and secondly, to answer whether you should follow the trend or just go by the Bollinger, see, trend can be defined as a long-term trend, short-term trend, whatever, but the Bollinger Band is normally used as a technical indicator for short-term trading normally. So within a let's say larger trend, we know that there might be smaller trends which might be on the other side of the larger trend. So if the larger trend is on the upside, does not mean that the every day the market will go up. Sometimes for a week or so the markets may be on the downside also. So in that sense, you have to it depends on what kind of trend we are talking about. So if it is a, let's say, the larger trend is on the upside, and then if you are a technical trader, then you might uh, play on the downside also, and then again on the upside also. So it's a combination of both. Okay, Punita's question is, how do we know the time taken for the possible trend to execute that we predict? Uh, so basically, what Punita is asking is, let's say, for example, if I am going long, from the various technical charts and indicators, I might come to know that, okay, this is the higher end, or this is where my targets are. But how do I know whether the target will be reached today or tomorrow, or whether it will take a week or so? Now, to answer your question, Punita, very directly, there is from the time this thing point of view, there is no indicator which tells us how much time it will take. Because if the momentum is very strong, it might happen within a couple of days, or it might take 3-4 weeks also. It all depends on the momentum of the market at that point in time. Secondly, it also depends on what kind of trend we're talking about. Say, for example, the market is already in a uptrend, and then you are going long because you got some indicator that you should go long. At that point in time, what will happen is, since the market has already been on a let's say upward journey, it might happen that it will take a little bit more time for your target to come, because the market has already seen a bit of a run up. Chances of correction increases at that time. On the contrary, if the market was on the downside and the trend is reversing, then what we have seen is that normally the reversal happens faster than the original trend. So it's called a faster retracement theory. So at that time, what it might happen that your target will come up very soon. So that way it is very difficult, or it's almost impossible to say what is the time that it will take. In technical analysis, we are only bothered about the prices, whether the prices are or the price levels are coming or not. The time factor is really something that is not studied that in so much details in technical analysis. Rupak's question is, which RSI chart is most important in swing trade? 1 minute, 5 minute, 15 minute. RSI charts are normally, they are basically the average of 14 intervals. That might be, so it depends on whether it's like 14 1 minute scale, or 15 1 minute 14 5-minute scales. It is normally in conjunction to the chart that you have. I mean, RSI in itself is not a chart, it's simply a indication. So it is, the numbers are derived from the chart that you are following along with the RSI. So in this particular example, if you look at the screen, we are following a this is a EOD chart with a 1 day kind of each candle signifies 1 day. So the RSI will automatically calculate within that 1 day this thing. Okay, so whether for swing trades, that is for intraday trades, if you want to follow 1 minute cycle, 5-minute cycle, it's all actually normally 1 minute is what is popularly followed. Okay, because 1 minute is a fair enough time for the market to react to any news or anything. 5 minutes, many times what happens is, during intraday, 5 minutes is becomes too much of a time. Because if you are let's say waiting for a trend to happen, and you're waiting for a particular signal to come in on the chart, and then you find that that signal has come, At that time, if you wait for another 5 minutes for the chart or the candle to confirm yourself, then many times it happens that the trend is lost. So 1 minute is what is usually followed. However, the other intervals like 5 minutes, 15 minutes are also useful, but they are again useful from the sense of confirming the trend rather than initiating a trade. Okay, so let's say, for example, if you want to initiate a trade, my suggestion would be follow the 1 minute chart. But once you have initiated the trend and now you're following the market, and you're kind of just following the market to see if the trend is continuing or not, then you simultaneously follow the 1 minute and 5 minutes. You kind of alter your charts accordingly. The same thing happens with the EOD chart also. This in this case we are seeing a 1 day EOD chart. We can make it a 5-day EOD chart or a 15-day EOD chart. Now, if I'm already having a position and I just want to confirm whether let's say, for example, if I'm long in the market and just want to confirm whether the market I should remain long or not, because in the last couple of weeks we are seeing that the range has become very narrow. So for people who are right now long in the market, the chances are very high that the market might correct a little bit from here. Okay, so whether to see whether you should hold on to your long position or not. So the one day the EOD charts is probably not giving you any indication right now. So what you can do is you can make it a 1 week chart. Then things will slightly change. The overall trend will obviously never change, but right now what is the scenario? It will give you a different perspective. So that will help you take a better decision. So 1 minute and 5 minutes, you correctly said that it is what is followed. Between 1 minute and 5 minute also, 1 minute is what is normally followed for intraday trading. Okay, another question is how technical analysis is different from fundamental analysis. Very basic question actually. Fundamental analysis actually is completely two different things. Without going too much into details, I'll just give you a gist of it. See, what happens in technical analysis is, okay, first of all, what happens in fundamental analysis is very specific to a company or to a industry or to an economy. Okay, so for example, if you're doing a fundamental analysis of a company, let's say State Bank, then your analysis is very specific to the banking industry. Within the banking industry also, within the PSU segment of the banking industry, and then specifically for State Bank as a company. So you kind of study a lot of things from a macro point of view, how the monetary policies and the economic scenario and the GDP and everything is impacting the banking as a sector. Which are the sectors where the banking is having maximum exposure. So for example, if steel is where the banking money has gone in, so how is the steel industry is also performing or is about to perform in the near future will also impact your balance sheets going forward. So there's a lot of study that happens. That is from the macro point of view. Then again, from micro point of view, you study how the company has performed, whether the performance has been at par with the peers or past performances, whether the anything that has deteriorated in terms of asset quality or anything that has improved in terms of, let's say, interest income or anything. So those things you kind of, there's a lot of numbers that you study, and then you come up with a suggestion that okay, the bank is fairly valued or overpriced or whatever might be your observation. And in case it is fairly valued, then you can probably go long in this bank with this kind of a target. So that is how this whole fundamental thing happens. So you can imagine it takes a lot of time. So if you have to come up with a fundamental price target for SBI, it will probably take you a couple of weeks, no less than a couple of weeks definitely, to study all these numbers that I just said. On the contrary, what technical analysis does, it does not bother about which company you are looking at or anything. It simply assumes that if in the past the prices have moved in a particular way, or the prices have behaved in a particular way because of any situation, then if that situation will repeat itself, then the price movement will also get repeated. Okay, so for example, if a group of people in the past have behaved in a particular way in a particular situation, then if the situation is repeated, then the same set of people will react similarly. So that is the underlying assumption for technical analysis. So what we do is we kind of in technical analysis we kind of find or identify patterns in the past, and then we see if that pattern is getting repeated in the future, or in the present rather, so that we know that, okay, now that the market is currently behaving like this, so how is the market expected to behave going forward? How do we come to know that? We kind of search for similar situations in the past. Okay, so for example, if you are layman in technical analysis and if you have to predict how the market is going to behave, let's say starting tomorrow, then what you'll have to do is you simply open up a technical chart, you look at how the market is currently behaving, you go back into technical chart, several years back if you want, and you see that in a scenario where the price movements were similar to how it is right now, how did the market behave after that? And that will give you a fair idea of how the market is going to behave. So that is how technical analysis works. It does not bother about which company you're looking at, or anything. So that's how, that is why technical analysis is becoming more and more popular, because it saves a lot of time, and it saves you a lot of effort also, and the fact that it can be applied to anything that has any kind of price movement. So be it a stock, be it an index, be it a commodity, currency, interest rates, anything that can be plotted on a chart, you can come up with a prediction. Obviously these predictions are all assumptions based on what? Based on previous or past price movements, so you cannot be 100% accurate all the time. There might be external factors which will impact your decision. Like, say, I'll give you a very good example, which is what is happening with the market right now. Say for example, if I have to very technically give you a view of how you should play the market right now. If you had asked me this question on Friday, I would have said that either you wait for the market to give you a correction, or you write a call, or if you are a risk taker, then you can probably go short also with a 150 or 200 kind of a price movement target in Nifty. But suddenly there was an announcement of a new RBI governor, and from the initial reports that we are seeing, the market might give him a very big thumbs up. So it might happen that tomorrow the market might see a big rally, because of that news. Now that news was not priced in the chart, if you look at it that way. Okay, so it becomes a certain kind of a news, and then it disrupts the entire chart pattern. So those things also happens, but more or less we have seen it that again and again the same price patterns keeps on repeating itself. So why bother and analyze all those fundamental numbers? You simply keep a tab of how the market is behaving currently and how the market behaved in the past in similar situations, and simply come up with a trend. That is very much easier to do, and that is how technical analysis works. Okay, so Rupashri is asking, what are the indicators do you suggest? See, as I said, the popular indicators that are currently are popularly used by traders in the market are, number one is, the first thing that they look at is the moving average. So if the market is currently above the moving average, below the moving average, or what. So for example, in this particular chart, if I have to remove this, clean this chart a little bit and show you this. So if I can remove the Bollinger Band, let me see. Okay, and let me put in the moving averages. You'll get an idea. Is this on? I'm not sure if this one is the moving average. Let me just try. Yeah, this one, moving average. So let us first draw a 50-day moving average. Okay, even the 50-day moving average is giving a very good signal right now. See, if you just follow my cursor, ever since the market reversed the trend, and initially it was going down, and then it reversed and started going up in the last 3 months or so. You'll find that from it was trading below the 50-day moving average largely, and then once it crossed over here, then the trend changed. and then every time it moved away a bit away from the moving average, it started giving you a correction, and then once again it resumed the rally. Nowhere ever in this entire rally which started in March, did the market once went below the moving average. The moving average becomes your very, very critical support level. Twice it just touched the moving average and then went up. So if you are long in the market from a positional point of view, then this 50-day moving average clearly becomes your support zone, or your support level, or your stop loss level rather. So once if you find that the market is breaching this 50-day moving average, now you can safely come out with your long position. So the moving average itself is something that the traders follows. Now the one moving average is not something that we follow. We normally compare it. We follow two moving averages simultaneously. So if you're a short-term trader, you'll probably follow a 50-day and a 21-day. So let me put a 21-day also here. See, like this. So many a times you will find that the market is moving below the 21 days, going below the 21 day, but it is not going below the 50-day. So that way you can come up with your trading strategy. So moving averages is something that is very, very that is the first thing that is actually seen. Then the RSI is also seen, and the Bollinger Bands are seen. Then the ROC is something that is also seen. Stochastics is seen, and MACD is seen. So probably these six indicators are enough for you to, if you are a practical trader, then you should get enough indications from these six indicators or six tools. Okay, Anand's question is how to avoid false signal. False signal, or technically there is a term that is used which is trader's remorse, that is used in technical analysis. Now it is something that is unavoidable actually, Anand, because it happens a lot of times that the indicators will tell that you should go long or short, and suddenly the market will change its direction. It is bound to happen. It will not happen always, but from time to time it will keep on happening. So there is no way to avoid it, but the only way to make sure that it does not affect you too much is by making sure that your position sizing is correct, which means that you are not putting in too much money into just one trades, and you are distributing your trades evenly over a period as well as over other asset classes also. So that is the only way to avoid this. Otherwise, it will happen. It will happen all the time. From time to time it will happen that your indicators will tell you that go long, and then suddenly the market will change its direction. It is a inherent disadvantage of technical analysis. If you look at the advantages and disadvantages, this is an inherent disadvantage. It's called trader's remorse, cannot be avoided. Another question by Vishnu is it wise to buy a stock when the stochastic is below 10? See, Vishnu, first of all, we cannot really answer this question by looking at the stochastics only. As I said, we have to look at other things also. Now, stochastics is also a leading indicator. It is also a momentum indicator, which means that it will give you an indication of whether the market is holding on to the momentum or is it losing momentum. So if the market is, let's say the trend is up, and the stochastics is giving you let's say small number like a 10 or 15 in your example that you suggest. So which means that even if the trend is up, the momentum of the market is lost. So the chances are very high that the market might correct. So that is one indicator only. So you just have to look at few other indicators to get a confirmation of the trend, and that only then you should kind of create a short position. If you are already long, then probably looking at the stochastics might be enough to come out of the position or put in a stop loss or something. But to create a fresh position, only looking at one indicator is never something that is suggested. You can kind of the first let's say decision might be based on that indicator, but that decision should be vetted by other indicators also. Okay, so let's say in your example, if you see that the stochastic is 10, which means on the lower side, then you're also seeing the RSI has tapered and it is coming down from an over let's say bot zone, and you're also seeing there is a crossover in the let's say moving averages. Then there are 2-3 indicators which are showing, which are telling you that the market's momentum is changing. Then you can safely, or let's say with much more confidence, you can go short in the market. Otherwise, looking at stochastics only and then coming up with a decision is always risky. Just give me a minute, guys. There is a issue with the mouse. I'm not able to use it. Just give me a minute. Okay, Harsh has a very interesting question. Harsh asks that, is it necessary to evaluate the trigger behind any reversal of trend, like results or margin? Now, Harsh, you'll find that, yeah, it is actually something that happens practically, that whenever there is a trend reversal, it does not happen all of a sudden. There are triggers. And more often than not, those are economic triggers or, macro triggers, which changes the trend, the larger trend of the market. So if you are seeing that from a long, let's say, or a medium trend, the market is looking to reverse itself, then you should definitely look that whether that trend or the reversal has anything to do with any kind of news. So if it is a stock specific reversal that we're talking about, then there might be stock specific news, or news from that sector. Or if you're looking at the market overall, then there might be global triggers, or even domestic triggers. So yes, it is very likely that if the trend of the market is reversing, then the triggers are there. I mean, like company results or mergers, or what the example that you have given. It's true. Okay, Rupashri has another question. What is ROC? ROC is the full form is rate of change of price. So it is similar to the RSI thing concept. The only thing is it is a momentum indicator, and it gives you a sense of whether the momentum of the market is sustaining or not. Okay, so let me see if I get the formula of the calculation. Let me show you in the chart first. It is not there in this chart. It basically compares the closing prices with a 14-day period, and it says that if the price the various closures that happen in the last 14 days, how whether the momentum is sustained or not. Okay, so for example, if the market, I mean, if I have to give you the example or the clarification in a very layman kind of a language, say for example, if the market was going this way, okay, and you'll find that the ROC was, let's say, 70 or 80, then if you'll find that after going like this, then the market is tapering. Okay, the ROC will at this particular level only will start coming down to, let's say, 20, 30 or something, because ROC will tell you that the market is, the momentum is not sustaining. Okay, so it is tapering. The rate of let's say the rate of increase of price or decrease of price depending on the trend is not sustaining. So that is what ROC is. So ROC will tell you that it is a leading indicator. It's a very, very good indicator. I personally use it very often to see if the momentum is changing. Okay, so if you are seeing that there is a very, very clear trend in the market ups on the upside or something, and if there is a ROC is tapering from the upside, then that means that the momentum of the market is not able to sustain the momentum, and there is a possibility that the market might correct. Now, whether it will be a small correction or whether it will be a big change in trend is something that happens over period. You cannot predict that immediately. So all you can do is you can kind of initiate a trade at that time, or if you are already long in the market, you can come out of your long positions and then see if how the market then follows up on the price movement. So how the other indicators then react to, and then you can decide whether it's a long-term short or just a correction or something. Yes, ROC is similar to slope of prices. Okay, another question relating to, it's not really a technical analysis question, but I'll still tell because it's related to the derivative market. How do we correlate the calls and the put data? Okay, so what happens in the call and put data? Actually, the entire derivative, the views that comes in from the derivative desk in any company or any broking firm is 90% based on the call and put data. The assumption is that, or the theory behind that is, if you have traded in options, you'll know this, that when you buy an option, let's say an option is trading for 50 rupees and the lot size is, let's say, 75, and I'm talking about Nifty. Okay, so or let's say for easier calculation, let's assume that the price is let's say 100 rupees and the lot size is 75. So that for buying one lot of Nifty, you'll need only 7,500 rupees. But the same thing, if you want to sell that 100 rupee call, then you'll need much more than 7,500. It's like you'll need the entire margin money. It differs from company to company, but it will be on the range of 35,000 to 40,000. So that's significantly more than the 7,500. Now, if let's say the price is 50 rupees, then the money that you need to buy an option is only 3,750. But the price, the money that you need to sell the option will still remain 35,000, 40,000. So what we are seeing is, playing in the options market is easy when you are on the buying side. Easy in the sense it's cheaper when you are in the buying side. However, the risks are pretty high. So what happens is that all the retail traders, they always think in terms of buying of options because they do not have the money to sell. But the HNIs and the other institutions and everything, they always look at it from the selling point of view, because selling gives you a lot of advantages in options. There is continuous erosion of time value. There is other option Greeks also works in favor of you if you are a seller of options. Okay, and you also have the money to do that. So what happens is, whenever we look at the options data and we see the open interest or the volumes, we always look at it from the seller's point of view. So if we see that, let's talk about Nifty. If Nifty is right now trading in the range of, let's say, 8,700 to 8,600, and the option data is suggesting that the maximum number of open positions are in the range of, let's say, 8,800 and 8,500. So it basically suggests that a lot of writing has happened at around that level. Just note my word, it's writing and not buying. We do not say that a lot of buying of calls has happened at 8,800 or a lot of buying of puts has happened at 8,500. Because what happens is, once you buy, there is someone who is selling also. So it's not that you are a buyer without a seller in the market. So there are equal numbers of buyers and sellers. So you always look at it from the seller's point of view, because the sellers have put in much more money than the buyers. So they probably have done much more research on the market than the buyers. Buyers are more speculators. Okay, so what happens is, if you look at the call data, put data, if you look at which levels the call and put open interest are maximum concentrated, you get an idea of the range of the current range of the market. Also, if you look at the change in that open interest, you'll come to know which direction the further momentum is getting built. So for example, if there is a 100 points rally in Nifty in any day, and you're seeing that the 8,800 call data's open interest is coming down, then that means that people who had shorted that call are now covering up their positions. So which means that people are not very comfortable shorting the 8,800 calls. So which in turn will mean that there is a possibility the market will breach the 8,800 level. On the other hand, if you are seeing that the market might go up also, might go down also, and whatever is happening, someday the market is going up, someday the market is going down, every day the more and more open interest is getting built on the 8,800 call. Suppose I'm talking about hypothetically. So that will then mean that, you know, more and more people are writing the 8,800 call every day. So the underlying assumption here is that whatever happens in this market, in this current expiry, the market will not breach the 8,800 levels. So that way the call data, put data are read. There are several other ways in which it is read also. There is a ratio, pull put call ratio, which is also seen. But we won't go into details of that, because this session is not really about that. But the call and put data is probably 90% of what the derivative analysis is. Okay, there is another question regarding, let me see the name, from Punita, asking the spinning top pattern. Now, spinning top is a technical pattern which normally occurs. It basically gives you a reversal of trend. Okay, the reason it's called a spinning top is because it looks like a top. So, for example, if I have to draw it, it will be something like this. So where there is a solid body, as well as there are candles both on the shadow both on the upside as well as the downside. So it's a very common this thing that happens. The only difference is it occurs, let's say, at the end of a trend. So for example, if there is already a trend that is happening, and at the end of the trend you suddenly find this kind of a pattern where there is a good shadow both on the upside as well as on the downside, you know, not just small shadows, good shadows, then it is a spinning top indicator. This is not something which is very popularly followed, because it does not really give you a signal very convincingly. You know, there are other trade reversal signals which are followed more widely, like a inverted hammer or something. Okay, these kind of signals are much more popular than a spinning top, because a spinning top, to identify a spinning top also is very difficult. It looks like a very normal candle or common candle, which you in any case look at it on an everyday basis, so you won't be able to identify if it's a spinning top or a normal candle. Okay, one other feature difference that will be there in spinning top is it will be opposite in color to the trend. So if it is an uptrend, let's say the market was in an uptrend, so most of the candles will be green, but the spinning top at that time will be red, or the other way around. If the market was on a downtrend, then most of the candles will be red, then the spinning top candle will be green. But as I said, it's not a very popularly used candle. So you can look at other candles also. The idea behind spinning top is similar to a doji kind of a thing. So a doji, what does a doji says? A doji says that the market is not able to decide the direction. So it is going up also, it's going down also, and finally it is settling at the same level. Okay, so a spinning top is similar to doji. The only difference is, let's say in case of a doji, you'll simply find a very straightforward like this. In spinning tops case, the only difference will be that instead of a flat line, you'll find a very small body. That's the only difference. Okay, so basically what it says is that it goes up and it goes down. The market is not able to decide which way it wants to move, and it closes almost at the same level where it opened. Okay, so spinning top, the way we use it normally is it's a caution or a stop or a wait kind of a signal, that you have to wait for the next day's confirmation. If the next day the next candle is a bearish candle, then you can say that the trend is probably reversing. Okay, any other queries that you have? Okay, so Anand is asking which is my favorite indicator. Basically, what I'm understanding is Anand is wanting to know what is the popular indicators that are followed in the market. As I already answered the question, I'll just repeat it quickly. What happens is when you look at, or let's say for example, if I'm a trader, okay, and I'm having no positions. Now tomorrow when the market opens, I want to create a position. Now first thing that I'll look at is the chart. So first of all, what I'll do is I'll decide what kind of chart I want to look at, whether I want to look at a EOD 1 day, 1 month, 1 week kind of a thing. I'll probably go through all of them, but I'll follow the 1 day EOD chart. So the first thing that I'll look at is the moving averages, how the prices are positioned vis-a-vis the moving averages. If the prices are very, very close to the moving averages, then it gives me a sense of let's say comfort, that it is not very, very oversold or overbought kind of a situation, or actually oversold overbought in that context will be a wrong word, or the comfort level will be higher in the sense that because many a times we have seen that the prices moves far away from the moving averages and then it comes back to the moving average. So if it is right now close to the moving averages, then I can probably get much more return from the market, compared to if it is already very, very far away from the moving averages, then I'll don't know how to trade it, because I know that it will come back to the moving average, but whether it will sharply come back right now or it will take some time, we don't know that. So the first thing that we look at it is how is the price currently placed vis-a-vis the moving averages. Now even within the moving averages, we look at a lot of moving averages. We'll probably continue to look at, or on a continuous basis we'll look at the 21 day and the 50 day. But before initiating the position, we also look at the positions of the other moving averages also, like the 100-day, 200-day, or a 5-day, just to know what is the worst case scenario. Okay, so the moving averages is what we look at first. Then we look at the RSIs to see if the timing is right, and we are not, let's say, if I want to go long, I don't want to go long when the market is overbought. Okay, so I just want to see if the timing is right. So how will I know if the timing is right? The ideal situation is if we are seeing that the market is, the RSI is giving you an upward slope. So that is the right time, because we know that the momentum is also up. Then we look at the ROC. ROC is similar to RSI. It will also give you the same direction 90% of the times. ROC, I'll just check just to reconfirm that there is no divergence, or the momentum is not fading away. Stochastics ROC, you may look at both of it, or you look at one of them or something. Okay, so also what we do is we create channels. We draw channels, we draw trend lines, we draw support levels. Okay, Fibonacci numbers is also something that is very commonly used. Very useful tool, Fibonacci numbers, and the levels that we derive from Fibonacci numbers are very useful. So we look at the Fibonacci numbers also. That will give you a sense of whether the market is currently near a support zone or a resistance zone. Okay, so looking after all of this, then if we find that there is a possibility of a trend, then we go for a trend. See, practically speaking, how we should look at it is exactly the way I described. First, you look at all the indicators, and then you allow the indicator to give you a sense of which direction the market is moving. Rather than, I mean, the way the mistake that people do is they already have a bias in their mind. The market is positive, I have to go long. Now let me see if the indicators are supporting my view or not. That's the wrong approach, because then you're already biased. So even if there is one or two indicators which is not giving you a buy signal, you'll probably ignore them, or you'll not give them enough credit. So that is how people lose money. So you have to look at all the indicators, and you have to see whether the trend is consistent across indicators. If it is consistent, you can go long, or go short, or whatever the direction is. Okay, Ratan's question is, if he is following 5-6 indicators, and one indicator out of them, or maybe two indicators, are giving a contra kind of a view, whereas the other 4-5 indicators are giving you same view, then what should you do? Should you ignore the other one or two view? The practical answer is yes. I mean, if let's say 4 or 5 indicators are giving you the same view. Let's say, for example, in this case, more often than not, you'll find that the view will be on the upside. Then the chances are very low that the other indicators will give you a sell signal. It's very low, unless the momentum is sloping down, or you are getting a the price, the trend is getting broken, or you're close to a resistance level. Unless it is like that, then you can practically speaking, it will not happen that way. So if 4 or 5 indicators are giving you a buy signal, then one or two indicators may give you a sideways signal, but probably not give you a sell signal. Okay, so in case you are getting it, you might choose to ignore also. There is no harm in that, because 4 5 signals, 4 5 indicators, if they are giving you the same signal, that is a good enough reason to create the position. Anand's question is, how do you decide the target level and the stop loss level for intraday trades? It depends on how have I come up with the trade decision in the first place. So for example, if I'm an intraday trader, in intraday, see, when you are trading intraday, these indicators are not that let's say useful, or not that effective, because by the time the trend happens, the price movements are very fast. So when you look at intraday, you are mostly concerned with levels. Okay, so there are levels. The levels might be pivot levels. The levels might be other important levels, historically important levels, or Fibonacci levels. So you simply follow the levels, and let's say, for example, let me just give you an example. So for example, today is Monday and the market has opened up positive or something, and you know that at around 87.20 there is a big resistance that the market is taking for the last 2 weeks. So 87.20 is where you, and let's say the market has opened up close to 8700. So should we, because it's a resistance level, should we immediately go short? Obviously the answer is no, because you have to wait for a few other signals, wait to see how the market is reacting to that level. And let's say, for example, if you see that the market is not able to cross that level, and on an intraday chart the moving averages are slowly changing direction on the downside, then you can probably go short. In this particular case, what will happen is you are very sure about the stop loss, but you're not too sure about the target, because you know that since 87.20 is the level which the market is not able to cross, then clearly 87.20 becomes your stop loss level. Now, so so the reason why you initiated the trade itself gives you the levels, so you're able to get you a stop loss level. Now the way the target is arrived is, normally you take a 2:1 or a 3:1 kind of a ratio. So if your stop loss is, let's say, 20 point, at a distance of 20 point from your current market price or your initiation price, then you keep a 40 point target or something, and on a general level I'm talking about. Unless again, before the 40 points is reached, you get another signal that the market is losing momentum on the downside, then you immediately book profit on that, or you hold on to it as long as the momentum is continuing. So that is how intraday trades are played. There is no hard and fast targets and stop losses that is there. You kind of initiate the trade, and then you just follow the momentum, and as soon as you see that the momentum is changing, you book your profits. See, Ratan's question is, can we use the leading as well as the lagging indicators alongside to create a signal? See, as the definition goes, the leading indicator, if you have to create a new position, create a new trade, then the leading indicator will be much more helpful than the lagging indicator, especially if the new trade that you are creating is against the existing trade that was going on. Okay, so for example, if the market was going up for the last 2-3 months and suddenly you want to go short, if you look at the MACDs and the other lagging indicators, it will be, they'll take a lot of time to give you a indication that the market has changed its direction. So if you have to wait for the lagging indicators to give you a signal, you'll lose on the opportunity to earn a bit more profit. So when you're talking about creating a position, you mostly look at the leading indicator, not the lagging indicator. However, if the position, if the direction in which you want to create your new trade is the same direction in which the market or the overall trend is already going on, then probably the lagging indicator, will also give you some help, because in any case the lagging indicator at that time will be on the upside only. But lagging indicators, the way it is practically used is, it is used to decide whether you want to continue in that position or you want to get out of that position. So once you have created a position, then the lagging indicators are something that you use to reconfirm or decide on how long to hold on to that position. I'm not sure what is a chart mantra. If it is something that you do with as part of your course, I'm not very aware of. And apply your strategies on the virtual game. I am not aware about this virtual game. Anyways, we won't get into a virtual stock game right now. It will be a waste of time. Any other doubts regarding Fibonacci numbers? You are all aware about the various Fibonacci numbers that are there. I mean, the levels that we normally follow. I'll just give you a brief kind of a shortcut tool for you to understand the Fibonacci numbers. Just give me a minute. I'm trying to open Excel. Let me see where it is. Okay, so when we look at Fibonacci numbers, basically what Fibonacci number says is that if there is a reversal of trend, or let's say not reversal, let's say there is a retracement of a trend, because we know that the trend is not always followed no, on an everyday basis. There will be times when there is a small correction and before the trend again resumes. So how long that correction will happen, or if there is a correction that's happening, how do you know that which are the important levels? That is how Fibonacci numbers are practically used. The only number that you got to remember is this 61.8. This is the only number that you have to memorize. All other levels, all other numbers you can actually derive from this 61.8. Okay, so how? So what is the next important Fibonacci numbers? How will you get it? If you know only this one number 61.8, you can derive that. All you have to do is subtract the 61.8 from 100. Okay, so 100 and 50, these are two basic levels which are there. I mean, this obviously needs no memorization. You can always remember 150. Other than 150, the 61.8 is a specific Fibonacci number. So once you have these two number 161.8, if you subtract it, you'll get 38.2. So this 38.2 becomes another very important Fibonacci number. How did you get this 31.2? Is simply by subtracting this 100, subtracting the 61.8 from 100. Okay, similarly, what is the next Fibonacci number? If you subtract this to 61.8 and 38.2, okay, so it will come to 61. Hold on, equals to 61.8 minus 38.2, so 23.6. So 23.6 becomes your next Fibonacci number. So likewise, so even I don't kind of memorize all the numbers. All I do is memorize this one number. Whenever I have to use it, I can derive the other numbers accordingly. In the chart, if you have to use, the way it is used is, for example, let's say let's take this as an example, or let's say this one. So there was a price trend reversal. Let me increase the chart. So let's say, just follow my cursor here. So from this level, around this level, there was a reversal, or there was a retracement of the falling index that we had for the last 1 year. And then around here, the market then took a brief resistance and it came down. Okay, so let's say, for example, if I look at this as the primary trend from this level to this level, and then we see if how far the market has fallen down. Let me see if there is a Fibonacci tool that I can use it. Okay, as you can see, there is so many indicators. Not all of them are really used all the time. Fibonacci is not given in this tool, so we cannot use it practically. But the way it will happen is, all you have to do is you take the lowest point. So let us say the lowest point was 68,050. Let's just take a round number for ease of calculation, and then it went up to, let's say, 8,000. Okay, here it is 8,000. So what you have to do is you have to find out by how much it went up. So it went up by 1150 points. Now then you apply the Fibonacci ratios to it. So you apply the first the smaller Fibonacci ratio first, so 23.6. So if you do a into 23.6%, so 270 points. So the first retracement from 8,000 level will be of a 271 points. So minus 271 points, let's say make it 270 only. So around 77.30 is where the market should um, retrace to. And if you just follow this line here, so it was taking a resistance here and then it retraced to approximately at this level. So you'll find that it was approximately that level only, 77207710. So what we can clearly see is the retracement level was following the Fibonacci ratios. Similarly, if you look at this and then assume this to be the level of resistance, and then the market came down here, if you do similar calculation, you will find that this gap is defined by the Fibonacci ratio only. So if tomorrow, if you see that the market is coming down from this level, and you want to see that, by how much the market will come down, you can actually make a calculation from the low that it made of 6830 approximately to where it is right now, and then you can find out if the retracement will be at 200 point, 300 point, how much retracement it will be. So Fibonacci ratios that way is very useful. Now let's say, for example, if it comes to this from 8,000 level, it comes to 7730 and still going down. So then we can assume that it will go down to the next level of Fibonacci, which will be multiplied by 38.2%. Okay, so 439 points. So this minus 400, let's say 40. So the next level of support will be at 7560. So that this level will come into picture only when this level is taken out. Okay, so that way you keep on getting the next levels of retracements. So Fibonacci ratios are also practically used very often. Okay, Anand, you are saying it's there, the Fibonacci, this thing is there. Where it is? I don't know, I'm not able to find it. Anyways, you got the idea.
Sir, it's in the select section actually, in the left top where NSE index is mentioned. You can see it. Select tools.
Tools. Where are tools?
No, sir. This actually in the left side. In the left side, actually, where you have see reset, undo, then select tool. Sir, just close the study. Yes, sir. Yes, sir. And yes, sir. This one the Fibonacci.
Okay, here it is giving you those levels 30, 38.2 and 50, 61.8. Actually, that is not very clear in this thing. But you got the idea. This is how the Fibonacci this thing is used. Anyways, let me remove this. Okay, so we have another 10 minutes. So anything that you want to further discuss, clarify? Okay, another question. Can we plot Fibonacci from any point, or do we need to take market bottom or top? Yeah, you have to take the market bottom and top only. Within the market bottom also the intraday low that it had made. So for example, in this particular example of Nifty, this was the low, the intraday low. Even if it was a swing low, this will be the level from which the Fibonacci this thing will be calculated. Okay, so from here, and assuming that you are currently here now, right now we are not there, we are actually here. So ideally we should not draw any Fibonacci from here. It was just for a academic purpose, just to show you how it works. So practically speaking, if you have to use it, then you use it from here, and then the way the market has behaved currently, it is at the top only. So you plot it, or you select the top point as the high that it has made, and normally in other charts that we use, automatically the other levels comes up. Okay, so that way you know that in case the market takes a resistance here, number one, we do not know whether it will take a resistance here in the first place or not. But if we see that it is taking a resistance, then it is likely to go down, and it will then give you the levels till which what levels the market is likely to go down. Okay, so in case we are seeing a reversal of a trend from here, since the trend has been very strong, in case there is a reversal, there is a good chance of making money here. Okay, because right now we are at the top. So all you have to do is draw the Fibonacci ratios, and you'll get a clear idea that if you have to go short, then where your target should be. So if you do not have any other further question, then we probably may end the session here. Azim, to answer your question, this is not actually a session that we had. This was more like a doubt clarification session. We discussed about technical analysis, which includes technical charts and indicators and all the things. So there is a full-fledged course for it. This session was basically meant for those people who have attended the course and they did not understand a few things. So so that they could come and clarify their doubts on this. The course name is technical analysis only. Or at least the subject is technical analysis. What you can do is you can get in touch with Sonal for more details on this. The detailed discussion will be during the course. This was not the course. This was the doubt clearing session. I was kind of assuming that you guys have gone through all these things that we have discussed today. And in case you had any doubt and there was one or two concepts that you did not understand, then that is something that I was supposed to clarify here. Amol, no problem. Once you do the classroom sessions for technical analysis, you'll get more clarification on the things that we discussed. Probably the reason you did not understand is because you have not gone through the classroom session first. Okay, so once you do the classroom sessions on technical analysis, and then you will probably understand this better. My name is Maloy Ghosh. In case you did not get your name, get my name, I have already put it on the chat box for you to see the spelling. Amor, once again, to get more details of the course, you'll have to probably get in touch with your course instructor or course coordinator, because I frankly am not very sure of what the course name is or how it is going to supposed to take. Okay, guys, so we'll end the session here. Thank you all for joining. I hope I was able to clarify a few doubts, and now you'll know a little bit more about technical analysis. So on that note, we'll end the session here. Thank you for joining.